let's kick things off, and we shall begin the presentation. So today's presentation is on borrowing in a self-managed superannuation funds, and largely what I'm going to speak to you about today is the issues associated with how and when you can borrow in a self-managed super fund, with the primary focus being on limited recourse borrowing arrangements. So I will spend the vast majority of the session today talking about limited recourse borrowing, but I'll also touch on a couple of the other key components of borrowing inside super and the impact that will have from an audit and potentially a compliance point of view in the SMSF. So from a learning outcomes point of view, hopefully by the end of it, you'll get an idea when an SMSF can and cannot borrow, and the time and value restrictions. So we've got this restriction associated, or this timing element. So where there are some borrowing capacities inside of the fund, we can certainly borrow for limited amount of time and for a limited amount of money, and I'll touch on those as I go through it. I'll also spend a bit of time going through the concept of repairs and maintenance versus improvements with an LRBA. So I think structurally the key issue of the session will be to talk through the structural elements of what a limited recourse borrowing arrangement looks like, but then I'll also focus on that repairs and maintenance side of things, and then the audit considerations. So generally I'll raise those audit considerations throughout the presentation from my experience with dealing with fund auditors over the journey with regards to any fund that's borrowing, the concepts that auditors will traditionally raise for us to contemplate. And I think it's always a little bit of a moving beast with these LRBAs and any form of borrowing arrangement. And often it's actually not the LRBA, but other sort of borrowing scenarios that for me lead to more audit queries with self-managed super funds these days. And then obviously just as tying it all up, and through the process, we'll talk about the consideration of when an LRBA comes to an end. And I'll address those issues as we go through. So that's obviously not chronologically what you're going to be learning. That's more about the concepts that I hope you to be able to take away from the session. What I will start though with is the borrowing exceptions, and then I'll work through the key structural considerations for limited recourse borrowing arrangements, and then the impact of super reform. I'm almost sort of to that point where we're 5 years on from, or pretty close to 5 years on from super reform, and so it's almost we've almost lost the need to use the word reform now, but the concepts of particularly something like limited recourse borrowing arrangements that are now coming up to 15 years from an existence point of view, I think it's important to recognise that while structurally most of the ground rules were set in the very early days of limited recourse borrowing arrangement, albeit they still provide problems for people these days, super reform has thrown up a number of other elements that we need to contemplate, and so it's worthwhile to be mindful of what the impact is going to be in those situations. What I would also say is that obviously this is a 1 hour webinar, so I will be working through it at a reasonable pace, but certainly in the second half of this calendar year, I will be hitting the road again and reintroducing my workshop concepts, and the workshop that I've been wanting to deliver for some time now is property investments in a self-managed superannuation fund. And so being that session is likely to be a half-day session, I will spend far more time digging and drilling into some of these key concepts that I'll be introducing you to or refreshing you on today. So borrowing from a superannuation point of view, and this goes right back ultimately to the original tax reform of sort of 98, 99, when a lot of the SIS reform back then and the introduction of self-managed super was one of it, when we moved from excluded funds to super funds sort of 12 months after. But we introduced a whole lot of related party legislation and redefined in-house assets and the like in that sort of 98, 99 period. And amongst that, it obviously redefined a lot of the investment restrictions that superannuation funds could undertake. So one of those restrictions was the capacity for a superannuation fund to borrow. And so there is a general prohibition within Section 67 of the SIS Act from super funds from borrowing. Now, SMSF ruling 2009/2 is a good document, probably of the SMSF rulings released. And, I'm not going to try. My goal is not to rate ATO rulings in order of favourite to least favourite, but I think the SMSF ruling 2009/2 is probably the most light on, particularly in light of all the limited recourse borrowing stuff that came out. And so I think it still leaves a little bit to be desired from a clarity point of view, particularly as I talk about things like constructive payments versus reimbursements. And so the concept of borrowing is that temporary transfer of money from one party to another with an obligation to repay. So the ATO ultimately stipulate that there has to be a transfer of cash in essence to the superannuation fund, for the superannuation fund to undertake a transaction with the obligation that they then have to pay that money back to the lending party. If there's no obligation to pay the money back, then we're talking about contributions, and it's a whole different kettle of fish. So in that instance, this whole idea of borrowing requiring the transfer of money to the super fund for then the expense or whatever to be paid with that obligation to repay is relatively straightforward. But then as you go through the ruling and it talks about and provides different examples, when it references things such as reimbursements, so an SMSF trustee paying an expense on behalf of the fund and then immediately seeking reimbursement, it talks about that as not being a borrowing. Now, we still see that sort of transaction occurring to this day, and preferably, and from an administrative, but not just an administrative point of view, also from an audit point of view, we would much rather see that all self-managed super funds, from an investment strategy point of view, first and foremost, contemplate and require and have that liquidity available to ensure that they can meet all their liabilities, so that we're not in a situation where the members or some other party is actually meeting the expense of the fund. Because if we're not in that position, then we're not even contemplating all of the, I guess, the peripheral borrowing issues that are thrown up in that SMSF ruling 2009/2. Because what they do identify as a borrowing arrangement is that further to cash going directly to the super fund for them to pay for something and then an obligation to repay, they do include constructive payments where the super fund agrees with the members for the members to undertake a transaction on behalf of the fund with an obligation for the super fund to repay that over time, and of course likely with interest. Now, of course, these rulings back from 2009 and 2008, when other SMSF rulings were written, were well in advance of a lot of the non-arm's length expense issues that we now have to address from a self-managed super fund point of view. So they don't really get too technical or too deep into some of those issues. But of course, if we're looking at constructive payments, if we're looking at any sort of borrowing arrangement, whether it's even from a reimbursement point of view, but anything where there is a fund expense or a fund outlay, and we're dealing with related parties, then we need to make sure that we're dealing on commercial terms. And so the borrowing exceptions, when they start to introduce things like constructive payments and things like that as to what could be considered a borrowing, then we still need to be mindful of all of our non-arm's length expenditure stuff as well. So it can get really confusing for the standard trustees trying to undertake their transactions. Hence why I go back to my original comment. In almost all circumstances, we should be encouraging, or not in almost all, in all circumstances, we should be encouraging trustees to pay all expenses from the fund's bank account. And I'll talk about limited recourse borrowing arrangements, as said in a moment. Of course, generally, a lot of the problems come from that point in time when they're trying to identify an asset to acquire, and where has the deposit been paid for. So all of those issues are pretty critical. But the obvious borrowing arrangements that the ATO allude to are your loans, but also your margin lending accounts. So margin lending accounts are not allowable in the superannuation scheme of things, and bank overdrafts, whereas things that aren't borrowings would be reimbursements. You've also got cash for difference, so your CFDs, but the issue with the CFD, and it's not really the context that I'm going to be speaking about today, but the CFDs, you had those where you had cash available to be able to top up your CFD account, no issue with that. But if you were putting assets in the place of cash to maintain your CFD account, then you're putting a charge over the asset, and that would be a breach of the regulation 1314 and the borrowing provisions. So you've got those things to consider there. Within the borrowing rules, there is the outlaying investment opportunities that are provided by such investment structures as derivatives, which are covered under SysReg. I think it's 1315A that provides for, subject to fund having a derivative risk statement, that a fund can invest in derivatives. And so, I think overall limited recourse borrowing arrangements ultimately stemmed from, and for those of us that have been around long enough, they ultimately stemmed from the fact that self-managed super funds and many other super funds were largely keen to invest in Telstra when the government sold down Telstra in 3 instalments over, so you had your T1, your T2 and your T3 arrangements. The ATO and APRA at that point in time said that was acceptable and that it wasn't a borrowing, but then they sort of revisited that early 2000s, probably just before T3, I think it would have been, and they sort of said, actually, we think this is a borrowing arrangement, so therefore any funds acquiring investments under an installment warrant arrangement are effectively putting a charge over that asset because you're getting the full entitlement to the dividends, and it's disallowable. So that then led to the advent of the limited recourse borrowing arrangement rules that we know today. But I'll come to those in a moment. We do have our 2 primary exceptions to the borrowing beyond LRBAs. And they are, and there is an additional one for surcharge, but given that surcharge was ultimately abolished well over 10 years ago now, there should be very few funds in any sort of circumstances that are still chasing surcharge liabilities and self-managed super funds needing to borrow to pay a surcharge liability. So we can consider that, albeit that it's in the legislation, as not relevant. But we have the capacity to do a temporary borrowing to pay a beneficiary. So if the fund is under an obligation, either via the law or by the governing rules, to pay a benefit to the member, so you might be thinking a pension payment, a lump sum withdrawal, potentially a death benefit payment, and they don't have the liquidity to pay it out in its entirety, then the super fund can borrow for a period that doesn't exceed 90 days and an amount that doesn't exceed 10% of the total fund assets. So it's a fairly limiting opportunity to borrow. And again, I would sort of always sort of put that warning in place that if you're going to do it to pay a benefit, you'd want to make sure that you've got liquidity coming in soon. And so if you're using it as a short-term measure because perhaps a term deposit or something else isn't going to mature in time for you to meet your pension obligation or to pay out a death benefit, and so therefore you draw money in to pay that benefit out, then where are you borrowing it from? What are the terms that you're entering into to borrow that money? Now, of course, this borrowing exception talks not only about borrowing money, but also maintaining a borrowing arrangement. So it's that capacity that borrowing, given that borrowing is a once-off event, the concept of maintaining an existing borrowing means that a fund that can breach it in the first year but can continue to breach it by maintaining a borrowing arrangement that's not allowable year after year. So it gives the auditor that recourse to continually report a fund for doing the wrong thing. The temporary borrowing to settle security transactions. So the securities, and there's quite an extensive list there, including bonds, debentures, stock bills, shares in company, units in a unit trust, futures contracts, currency swaps, forward exchange rate contracts, all sorts of things are listed in the legislation. You can borrow to settle on a security, so long as when the investment decision was made, it was not expected the borrowing would be needed. So this comes back to ultimately the days of T+3 concept, where you would have your money sitting in your bank account and you would put in a trade to buy some shares, knowing that you had the money in an account, and then lo and behold, some admin fees, accounting fees, audit fees, something else came out of the fund, insurance premium, an automatic debit that you hadn't contemplated, and therefore there was a shortfall in the capacity to pay for those shares. So in that instance, you had the capacity to borrow, again, up to 10% of the total asset value of the fund, but in this instance, not exceeding 7 days. So the reality of admin for me is that that bottom concept, the temporary borrowing to settle security transactions, is almost like a non-event in the SMSF space, or should be a non-event in the SMSF space, because ultimately it's part of the investment strategy. If you're going to invest, have the liquidity in there. Similarly, with the borrowing to pay a benefit, it should be or is a minimal situation where that's going to occur, and ultimately, as I highlighted before, it may be because you're waiting for an asset to mature or expire or whatever it might be, and the liquidity to hit the fund. Clearly, a fund should be contemplating these sorts of things prior to that point in time, but often there may be emergency situations that arise, or scenarios that occur. It might be from a disability benefit payment or something else that you require to make some form of payment, and you need to top it up if you haven't got the liquidity in the fund. So again, key issues to be mindful of. But let's move into, I guess, then what the primary borrowing opportunity is for superannuation funds, and that is the concept of limited recourse borrowing arrangements. And what I want to do, and what I've done for you here, is I've provided effectively a timeline, which for me is certainly not all of the events, but most of the key events for self-managed super funds and the capacity to borrow, and just identifying some of the key documentation that went with it. So pre-1999, we had pre-99 unit trust and pre-99 companies that could almost do anything. I'll go through the structure of one of those in a moment. And those investment vehicles could actually borrow. So before 2000, or before the year 2000 and beyond August 1999, we ultimately changed the rules and restricted what a fund could do. But before that point, realistically, if you invested through some other vehicle, then borrowing was still possible. We then had this period of time, ultimately leading up to when the first major super reform occurred in 2007 financial year, and this was obviously included all of the Telstra instalment periods, and there was also Commonwealth Bank, but Telstra was clearly the biggest one at the time. And so what happened in September 2007 was the government of the day introduced a new piece of legislation, which was in addition to Section 67 exceptions, and it was Section 67 4A, instalment warrants. So you could actually borrow to buy instalment warrants. But as I'll run through in a moment, it expanded well beyond that and gave us the capacity to borrow to acquire an asset. That led to lots of speculation about how the rules actually worked. And so the ATO and Treasury and industry worked together over the ensuing sort of 2.5, 3 years. And we got new legislation in July 2010, which is the current legislation, Section 67A and 67B, limited recourse borrowing arrangements. So we went from instalment warrant arrangements to limited recourse borrowing arrangements. That then led to a significant release by the ATO of a substantial number of interpretive decisions to deal with a number of the key elements that arose from moving from the old method to the new method. But ultimately, if I was to summarize, I would say under the old method, you had far greater flexibility in what you could borrow to do, and things such as the replacement rules, but there were stricter conditions around the lending side of things, particularly around refinancing and things, without creating future problems for your fund. We then had, again, as an extension and largely from one of those releases, which was, I think, the 2010 162 about related party lenders, we had this problem, obviously, which was zero rate or zero interest on limited recourse borrowing and paying amounts out at the end of the term, which then led us to 2016 reform, which was around non-arm's length income, and then how to create an arm's length arrangement for your self-managed superannuation funds that had entered limited recourse arrangements before 2016 that weren't on arm's length terms. We then had super reform. We then had a product ruling in 2020, which introduced this concept of intermediary limited recourse borrowing arrangements, and I want to spend a few minutes talking about that today. We then had the early release stuff of our non-arm's length expenses, which largely was driven by limited recourse borrowing arrangements and lower than commercial rates of interest. So that was primarily the reason behind that LCR. We know where that has ended up, and we know that that's under continued review. But also in the meantime, we've also been dealing with the impact of COVID-19. And so the impact of COVID-19 is ultimately that a lot of people couldn't meet their LRBA repayments, and the tax office have obviously provided continued extensions onto the commerciality of these, where if you are having deferral of LRBA arrangements and repayments in accordance with what is otherwise being offered by the banks, that it doesn't create a non-arm's length expense situation for the fund. But of course, if you're doing a related party loan, you have to make sure that the term is not extended, and therefore the repayments, once you come out of that COVID sort of deferral period, the repayments are going to increase significantly. So presumably a lot of parties are at that point now where they're starting to come out of that. And so that's actually going to have an impact, I suspect, over the next few financial years on how LRBAs are operated and maintained. So very quickly, from a pre-99 unit trust point of view, as you can see from the imagery there, the self-managed super fund would invest in the related trust and receive the trust distributions. The trust would borrow and would borrow effectively against the assets of the trust and for any sort of purpose. And the super fund's investment was just exclusively an investment in the units in that trust, and the activity of the trust were not necessarily scrutinised by the tax office. Of course, history will show that there is now an element of scrutiny with regards to things such as a sole purpose test and the maintenance of these sorts of investments to provide for a member's benefit. But if you still have a pre-99 unit trust, that unit trust can still invest in multiple assets. That unit trust can still borrow money and maintain existing borrowing. So it still has lots of flexibility. It's just that the self-managed super fund can no longer reinvest in that trust. So there's just a couple of those key documents that the ATO have released. And that related party borrowing on favourable terms was really the key of, I guess, to put it bluntly, the nightmare 10 years that followed with reference to all of the comings and goings and lots of additional interpretive decisions about whether or not the income that the fund received was non-arm's length income, all because in that ATO ID 2010-162, the question asked was, is a borrowing or is a loan from a related party at lower than commercial interest rate a breach of Section 109 arm's length requirements? And the ATO answered, in regards to Section 109, it is not a breach, because a lower than interest rate loan was favourable to the super fund, not favourable to the related party, and Section 109 required the transaction to be more favourable to the related party. So ensured that if it was more favourable to the related party, then it would be a non-arm's length transaction. So that document ultimately opened up the Pandora's box of LRBAs with 0% interest rates and other things being promoted throughout the industry, and then really meant it took the ATO a good 6 years to sort of keep doubling down on it is a tax issue, not a super issue, and ultimately where we've ended up today with the non-arm's length income requirements. But just probably a couple of other key ones from that. Some of the conversation that I'm going to have around the repairs and maintenance stuff and improvements is drilled down to an SMSF ruling 2010-1. That 2012 one, the ATO ID 2010-185 is really about the on-lending arrangement. So if a bank lends to a member and then the member does a related party loan, that the bank can't put a charge over the asset of the superannuation fund. So as I said, a lot of those IDs were to stipulate the difference in the rules between pre 2010 and post 2010 arrangements. And then of course we've got the PCGs and the TDs dealing with the gnarly stuff towards the end. So we all know what a limited recourse borrowing arrangement looks like. We've got the lender lending money to the super fund. The super fund then acquires the asset, and the asset is held in the holding trust. I'll use the word holding trust. Others will use different terminology: security trust, bear trust, property trust, whatever it might be. I'll generally use the terminology of holding trust there. So we understand structurally how it should be working in that situation. This one here is a little bit that I highlighted just before of the ATO ID 2010-185 consideration. In this situation, the lender would lend money to the member as a related party, and they would then on-lend that money to the super fund to acquire the asset. So you get the same outcome, but in this instance, it's the member who effectively has recourse over the fund. And it is the member who should be registering. If they're registering the mortgage in accordance with the PCG, then they're the ones that are registering it. The lender to them is obviously taking some other form of security, potentially against their own home or other investments, to undertake that transaction. So that's just an alternative style arrangement that you tend to see in the LRBA space. So the key requirements of the limited recourse borrowing arrangement, and I think it's always good to go back and address some of these key requirements over time, given, as I said, we are talking about 15 years down the track, and then more specifically from the section 67A, we're talking about 12 years ago that this was introduced. And we kind of think, well, LRBAs, they get scrutinized a lot. They are often referred to by governments or through election cycles and that about the capacity, whether they should be retained in superannuation. So they're always front of mind. And I can guarantee that from a compliance and administrative point of view, I still am seeing regular questions. And in fact, in preparing for this webinar, in the last week alone, I've had questions around extensions to existing properties, about adding granny flats to existing properties, around other things in reference to paying the deposit and then transferring the asset from a personal name to a super fund name, and all those sorts of questions that inevitably were asked 15 and 12 years ago or however long ago are still being asked today. And it's because most people that deal in this space only deal in it with a few number of funds. So those that are dealing with it on an ongoing basis, they understand the rules. Their clients understand the rules, and they have a lot of material on it. But when you are addressing clients who are thinking about it for the first time, then there's a little bit of research that needs to go into it. So firstly, the borrowing must be applied to the acquisition of a single acquirable asset. So that's where that SMSF ruling 2012-1 is really good in first identifying what a single acquirable asset is, because certainly prior to, and I said I've got some highlights of the difference between the pre and the post 2010 rules, but prior to 2010, the identification of an asset was fairly flimsy, to say the best. And so this concept of single acquirable asset, whilst it made it far more restrictive in what could be done, it at least helped identify the idea that the super fund could only acquire X, not Y. And I had a question. I was at a presentation the other day, and someone was talking about. I was actually talking about downsizer contributions, and I was highlighting that you can't use a downsizer contribution to if you sell your caravan. And it led to a question where saying, what if that caravan's on, is fixed on the block of land? Would that be considered your primary place of residence in a house? Now, I kind of threw that away as a question and said, well, look, definition of a caravan would be a caravan. So if you're selling a caravan attached to that block and you're selling the whole block, then you're actually selling two different items. Whether it's fixed or not is another issue. I said, if you look at things from a business real property point of view, items like caravans would normally be considered a separate investment because they are not a permanent fixture to the land. Now, obviously, in some instances, they can be plumbed in and made a permanent fixture, but that's less likely to be the situation. So when you're talking about single acquirable asset and you're largely talking about property, it is what is a fixture to that property that is permanent from a structural point of view. And if you've got two land titles, and this was one of the key issues of the single acquirable asset, if you've got two land titles and you want to sell them both together under an LRBA, if there's nothing that is forcing them to be sold together other than vendor choice, so if there's no legal impediment to splitting them, then you cannot acquire that under a single limited recourse borrowing arrangement. So you need to be mindful of how those rules work. The asset cannot be improved with borrowing, repaired or maintained. So that whole concept about improvement versus repairs and maintenance, I'll touch on again in a moment. Can be improved with fund monies, but no change in the fundamental nature of the asset. And again, the concept of adding a bedroom to a house, adding a granny flat, that SMSF ruling 2012-1 does provide some really good examples of what would and what wouldn't be considered an improvement. And ultimately, it's going to come down to the nature of the transaction and the nature of the investment as to whether you are changing the nature. The loan is to the SMSF trustee and it can be refinanced. So this is what Section 67A talks about. And then we've got, there's a loan and the asset is held on trust. We've then got the intermediary LRBA, which I'll touch on in a moment. The rights of the lender or other parties against the SMSF limited to that acquirable asset. And that was one of the key differences before 2010 was the rights of lenders and other parties. Mixes that the government made was that if you had third-party guarantees, that there wasn't any real legislative protection against them taking action against the assets of the fund, and so they wanted to tidy it up to make it against all parties. The assets held in custodial holding trust, and there is an in-house asset exemption. So in 2014, the way that the in-house asset exemptions work, it said was if you've got an asset subject to a limited recourse borrowing arrangement, then it would be excluded as a related trust from the in-house asset definition. But by extension, then the problem was, well, what if you set that trust up first, the point in time before you actually had the borrowing, so the money hasn't actually been drawn down yet, and then after the event. And so we had a legislative instrument in 2014 that corrected the position to say that at any time that you hold that asset in the trust, it is, whether the borrowing arrangement's in place or not, it is subject to an in-house asset exemption, which then leads itself to the idea of what happens and what's one of the main considerations when you get out of a limited recourse borrowing arrangement, because these rules and these discussion points were largely driven by the fact that there was always that fear, and this is why where the transactions are paid for is so critical, is that there was that fear amongst the industry and amongst participants in undertaking LRBAs, that when they sold the asset would be transferred from the holding trust to the super fund, and so it would trigger a stamp duty event. And so this in-house asset exemption goes some way towards removing that fear by saying, well, under one set of circumstances, you can actually leave the asset in the holding trust and retain that investment from the self-managed super fund point of view. So you don't actually ever have to transfer the asset and take ownership under the legal title of the superannuation fund. Now, in saying that, I'm not suggesting that that's the best way to go, but it is a provision of these exceptions that you don't have to do the transfer. Of course, if you did all of the transactions correctly to start with, then and you set up the holding trust correctly to show that the holding trustee is holding the asset, that the owner of the property, the eventual owner of the property as a superannuation fund, then you can avoid that double stamp duty anyhow. And again, stamp duty being a state-based provision, but you're only looking at the nominal stamping, which I think, depending on where you are, might be $50, $100, but not a significant amount, not compared to the entire property transfer. So yes, there would be stamp duty when you acquire the asset in first instance, but not when you transfer it from the holding trust to the super fund. So that's one of the considerations to contemplate, because there was in the early days, people were thinking, okay, well, what we have to do then is ensure that we never pay out the loan before we sell down the asset, so you can retain the asset in that holding trust, have a very minimal loan amount, and then avoid that potential stamp duty issue. But that legislative instrument that came out in 2014 addressed that and provided the capacity to retain the asset in that holding trust if you so choose. And as I said, the SMSF has that immediate beneficial interest in the asset, plus that right to acquire. So again, the main differences between 2007 and 2010 rules, so the 2010 rules being what we have now, and there's a reason why I highlight that, and I'll go through it in a moment, is that the acquirable asset could be altered from multiple to single or a single collection. So the acquirable asset previously was just an asset. And so you could, in theory, under the pre-2010 rules, you could buy shares and you could replace it with property, right? So it was that broad in its definition of what you could actually do, that the government recognised that it needed to be tidied up. Now, if you have or your clients have a pre-2010 instalment warrant arrangement, then those rules still apply, unless they go through the process of refinancing it, because if they refinance it, they have to make sure it satisfies the conditions of 2010 as well. And of course, so if they entered into it under non-related party, a related party lender on non-commercial terms, and they were compelled to effectively fix it come 2017, which probably meant they've addressed these issues now. But your rules around the old ones were far more flexible from an investment point of view. Previously, the recourse against the SMSF was only applicable to the lender. Now it's to any party. So again, that gives us greater capacity with reference to make sure that the asset of the funds are protected. And as I said, the circumstances which assets can be replaced are now prescribed. So very, very restrictive. And ultimately, look, I don't see it administratively so much these days, but people utilising these to acquire listed securities or a parcel of shares or other investments is fairly minimal. We are still largely talking about property transactions, albeit that I understand and appreciate that you can still, and certainly PCG 2016-5 addresses using it to acquire listed securities. Now, the interesting thing there is that definition of single acquirable asset and how it fits in with that. And basically, it's based on a per order, not per settlement of the order. So if you put an order in for 10,000 BHP shares under a limited recourse borrowing arrangement, and that order is delivered in 3 parcels, then it's still that 10,000 that is considered the single acquirable asset, which means you buy it as 10,000 and you sell it as 10,000 as such. You could have contemplated things like dividend reinvestments and that as well, but now all those sorts of things are effectively replacement assets that no longer exist. And as I said, the refinancing does create a problem, which then leads me on to the financing issues. And I've just had a question come through, so just let me read that one out. One thing I've come across recently, after a loan has been paid out and the asset remains in the holding trust, auditors may take exception to not discharging the mortgage, possible breach of having a charge over the asset once the loan is paid out. Have I seen this? What's my view? Well, look, I guess my view on that is that that certainly it's part of the process that if people follow the practical compliance guidelines appropriately, then they need to register the mortgage as such. So if that's occurred, and then they don't undertake the discharging of that mortgage when it's paid out, then yes, the auditor has, I think, quite rightly pointed out that you've got to charge over the asset. Now, ultimately, if you can prove that it's there's no charge over it, then the next step is to discharge that and get the encumbrance removed from the title. So to me, it becomes a little bit of a practical situation where you try to address it in that conversation and hopefully rectify the situation for the auditor, but then maintain it in that trust if you feel appropriate. So that's the way that I would address that there. So as I said, the financing issues, and just being quick on these matters, realistically come down to the fact that you've got that old ATO ID 2010-162, where it wasn't a contravention of Section 109 of the SIS Act, and therefore you could charge a reduced rate of interest. And then the ATO went through a whole sort of process of determining whether or not something was considered to be a contribution or not. And then that was followed up by the introduction of tax determined 2016, which confirmed that the loan would be in breach of Section 295/550, and it kind of got you to undertake a process of saying, go out and test your loan against the market, and if your loan is measurable against the market, then it's going to be acceptable. But if it's not acceptable, so if you can't find your terms, your conditions in the market, then ultimately you wouldn't actually be entitled to receive the income that you're currently getting, and therefore the income is non-arm's length. So it kind of required you to undertake a test, which then resulted in the release of the safe harbour rules for limited recourse borrowing arrangements, and of course applying to property or listed security. And again, today I'm not going to go through all of the issues associated with that PCG, other than to say that the tax office have recently updated that PCG in lieu of the release of LCR 2021-2, which talked about if you've got non-arm's length expenses at any point in time in the transaction of acquiring an asset, then non-arm's length income will apply to all income of that asset for now and forever, including the capital gains. Now, what the industry took again issue with in that regard is, well, hang on, back when you released this PCG 2016-5, the whole idea was prior to 2018 in effect, so prior to, or 2017, because it was 31 January 2017, but prior to that date, you had time to rectify your non-arm's length transaction to make it arm's length. And so therefore the LCR ultimately, which applied from 2018 onwards, the LCR then came in and suggested that if it was ever non-arm's length, then it's always going to be non-arm's length and you've got a problem. Well, the ATO have just updated that PCG to say that if you had a limited recourse borrowing arrangement that was reclassified or the loan was redone to bring it into line with PCG 2016-5 in that time frame before 31 January 2017, then the ATO won't be applying compliance resources to it after 2018. So basically, if you fixed it back then it should be safe from the gnarly provisions moving forward. The other key thing that I would talk about with reference to the PCG as such and the safe harbour rules is that I often get the question, and I assume many of you do as well, do we have to follow the safe harbour rules with a related party loan? And the short answer to that is no, you don't. But what you have to do is you have to make sure that the terms of the loan are commercial so that you can go out to anywhere and find that loan, that rate, that whole setup for the arrangement that your super fund is going to entertain. What the PCG does is effectively gives you that compliance relief that the ATO aren't going to come knocking on your door and looking at your limited recourse borrowing arrangement to see if it does comply. If you go and apply other related party terms to your loans or other terms to your related party loan, then you don't have that guarantee from the tax office that they won't review your fund. But again, if you go in and enter into a related party loan on commercial terms because you've gone and done your research, and it might be subject to the interest rates. I've seen a lot of related party loans over the last few years, particularly sort of in that COVID period, early COVID period, where interest rates were going down quite significantly, where people were saying, well, actually the PCG interest rates are quite high comparative to what you can get on the market. So is there capacity for us to apply lower rates if we can get sign off from a bank that they would provide that rate to us? And so, if people want to address that, then they can certainly go down that path. So look, again, just a couple of the LRBA issues is not only do you have to follow the LRBA rules, but you've got to make sure that you're satisfying the arm's length rules, the lending rules, the acquisition of assets from related party rules, or your in-house asset and sole purpose test as well. So from there, you have to ask the question, or what impact has super reform had on limited recourse borrowing arrangements? So for me, I guess the main thing about super reform, if you consider and encapsulate in that super reform things like PCG 2016-5, then obviously the capacity to refinance a loan is going to impact those pre-July 2010 LRBAs. Similarly with the post-July 2010, where you had varying interest rates. But then your 2017 and your 2008 limited recourse borrowing arrangements are going to be impacted by super reform because of their link to both the transfer balance cap and total super balance. And as I finish up the presentation, I'll run through just an example of how LRBAs do impact both the total super balance and transfer balance cap measure. But then the other thing that came in from all of this was this concept of intermediary limited recourse borrowing arrangements. And really, without going through, I'll put all the information in these next two slides for you, but I don't want to dwell too long on them, because I wanted to focus a little bit more on the repairs and improvement side of things. But ultimately, this concept of an intermediary LRBA has actually been around much longer than 2020. But prior to 2020, the conjecture was that the investment would actually fail the definition of an in-house asset, because in these situations, what was being undertaken was an interpretation of the way that Section 67A was written. And instead of lending the money to the self-managed super fund trustee, the money was actually being lent to the holding trust. And so what the ATO undertook, and it was over some period of time, they undertook, I guess, their process of reviewing these sorts of arrangements, and they finally released or landed on this this product ruling, this legislative instrument of 2021, which talks about having a holding trust that's established with the members of the fund being the only trustees or shareholders and directors of the corporate trustee. So there's a link to obviously the fund membership and who are the directors of the holding trust, and therefore those directors being the shareholders as well. The trustee is the beneficiary of the holding trust, so the trustee of the fund obviously is a beneficiary, so that meets the conditions of the LRBA. Holding trust holds an acquirable asset on trust for the asset who is beneficially entitled to the asset single acquirable, so it meets those requirements. The holding trust, and this is the key one, the holding trust enters into a borrowing as principal with the lender, with the borrowing secured by a mortgage over the asset. So realistically, what it's saying is that in this instance, and that it's the contract or deed, that you have the legal document to support that. So ultimately, when you go through the various rules, and like if you look at 8.1 there, trustee maintain all borrowing obligations entered into by the holding trustee in respect of the borrowing. So everything in these arrangements puts the onus back on the SMSF trustee to make the repayments, to be entitled to the income and all those other things. But the big difference is that the loan is to this holding trust, so it ultimately removes some of the issues as far as where do we find a lender. So all of those lenders that left the market from an SMSF trustee point of view, will they or are they still lending to these intermediary or to these holding trusts? So is there limited issue? Obviously, there's still limited recourse over the asset of the fund and the assets of the fund, but the holding trust may be able to, provide different rules around the loan, closer to a normal home loan or investment loan type arrangement. So, the key difference with the intermediary LRBA arrangement versus a standard one is that the lender is actually lending that money to the holding trust for the acquisition of assets, and the SMSF is making the repayments to the lender and undertaking all of its other obligations. So, you do see a few of these around, and there are some providers that promote them as well. So it's one to be mindful of. And particularly, I guess, where we've seen these from an audit point of view, is that you go through these 9 conditions of the 2020/1 document, and there'll be a couple of those conditions that aren't being met in the transaction. So then the auditor will suggest, okay, well, then you've got an investment in a related trust, and that related trust has a loan into it, and so therefore it is in breach of the in-house asset rules itself. And really, that was the key to these intermediary things, was ensuring that the intermediary wasn't considered an in-house asset, similarly to how the holding trust wasn't an in-house asset when the loan sat inside the superannuation fund. And of course, that being the key difference there. So some of the strategic and compliance issues that obviously we come across with regards to limited recourse borrowing arrangements stem from the idea of demolishing a place and rebuilding it. And so, what are you replacing it with, or how much work is going into that, versus saying doing an improvement with it. And clearly you can have some issues associated with that, albeit that, again, if you've got an event that occurs, a fire or whatever, and you're using insurance proceeds and you demolish it and build it as it was, as a house or something, then it's still going to be okay. But if you buy a property and demolish it and put something totally different on there, then you're going to have some issues to consider. Subdivision is not possible because you're altering the asset. But then you've got things like renovations and property fit outs, and who pays for that? Does it become part of the property itself? What are the lease arrangements in place, and how do they deal with that? And I think they're not actually just limited recourse borrowing arrangements issues. They're actually property investment issues for self-managed superannuation funds, and who's funding it, how do we fund it, who's bearing the cost, and therefore it starts to really move into that whole Section 17B trustee remuneration stuff. It really looks into the contribution rules under TR 2010-1, the acquisition of an asset rule under SMSF 2010-1, and also the LCR 2021/2. So, a lot of the compliance issues associated with limited recourse borrowing arrangements, if we appreciate that we can't replace the asset, that's something that it wasn't before, and if we appreciate that we can't acquire something that sits over multiple titles that aren't affixed to each other, then a lot of the other rules really come down to making sure that we're meeting all of the other key components of dealing in property transactions that we have to address in other places. Which then does lead into the concept of repairs and maintenance versus improvements with regards to these funds. And I guess for me, what we need to know is, what can you do with borrowed money, and then who can undertake repairs, maintenance, and or improvements, and then what other SIS and tax issues exist. And again, that in itself is a fairly sort of comprehensive subject matter, but the whole concept of what you can do with borrowed money is you can repair an asset and you can maintain it. So you can repair it to put it back to its original working state, or you can maintain it so that you don't need to repair it, obviously. And so what you're looking at there is that you can use borrowed money to do it. So if the lender has that redraw capacity, where you can redraw down from the loan, or the original loan is such that you have that amount built in there to be able to use it for repairs and maintenance, then that's fine. You can't enter into a further borrowing arrangement for the money, but you can potentially draw down to undertake those repairs and maintenance. Versus improvements, where under no circumstances can you borrow to improve an asset. So improvement is ultimately if you're going to, and the thing about repairing and maintenance, if you're repairing an asset, you can repair it and obviously upgrade it, so you can put in better guttering. If the guttering is broken, you're replacing the guttering with the newer style guttering, then that is still a repair as such. But if you decide to replace the whole roof and put another room on or whatever, then you're actually making improvement to that property, and it's going to create other issues. So just on a question that's come in there, does that mean if the loan has a redraw facility and there is room to redraw could you redraw to make these repairs? Well, if you do have a loan with those redraw facilities, and again, one of the things I think to be mindful of is whether you do actually have that redraw in there. But absolutely, if you had that redraw capacity, then you could actually use those redraws to make those repairs to the asset, as long as you're not changing the nature. So as long as you're not making improvements. So again, that SMSF ruling 2012-1 is a very good document, because it has some tables. And look, what I'm trying to do for that property workshop is put together a far more comprehensive guide that works through the variations of maintenance and repairs versus improvements. But that 2012-1 is a great starting guide to get an identification as to what you can and can't do as to whether something is a repair or not. And so from that, the outtake of that being that if you've got a residential property and you wish to demolish and put in a new kitchen, well, that's an improvement versus a repair and maintenance versus, say, replacing the stove with a new stove. Now, that improvement can be done because it doesn't change the nature of the asset, but you can't use borrowed monies for it. Similarly to the question that I had the other day about a granny flat, can you add a granny flat to a residential property? The answer to that is yes, you can, because it's still a residential property. So you're not changing the nature of the investment. If you add a pool, if you add a garage, all those sorts of things don't change the nature of it. And obviously you've got to determine whether the expense that you're going to is worth the income that you're going to generate from it. So it has far broader sole purpose test considerations and things that you have to think through, in addition to what those improvements versus repairs and maintenance are. And of course, the other side of that is the other system tax issues, which I addressed a little bit on the previous slide, which was the whole concept of contributions versus acquisition of asset from a related party versus non-arm's length expense, and who are you engaging to undertake the work. Because if we look at the non-arm's length expense nature or rules as such, and we're talking about repairs and maintenance, if we in our trustee capacity undertake that repairs and maintenance, then where do we get, and I don't necessarily think the LCR covers this well enough, where is the line between undertaking repairs as a trustee versus undertaking those repairs as an individual? Because if you're not a builder, if you're not qualified to undertake those repairs, then ultimately, one, you can't be paid for it. But then two, if you can't be paid for it, does that mean it's a non-arm's length expense and therefore creates income issues for the fund in the future? And to me, that's one of the real sort of black hole elements of the LCR, is that differentiating between individual and trustee responsibility. So that's one of the key issues that I think we need to be mindful of from a structural point of view, and from a strategic and ongoing point of view. We need to obviously think about the timing of things like the establishment of the holding trust, and obviously the timing of putting down a deposit on a property, the structural considerations, so corporate trustees versus individual trustees, what documentation are we going to entertain and consider there, and then what are the lending conditions, knowing that the PCG conditions are fairly restrictive. Do you have the appropriate insurance? From a replacement asset point of view, the insurance money can be used to rebuild the property, and have you considered that as part of the fund's investment strategy? And again, I'll put that point there about death or disablement, because there's this real issue around insurance, where what its purpose is for. And you know, strategically, I'd put a warning. I probably should have put a warning sign next to it. Is that strategically, a lot of people talked about, including myself, the idea of holding death and disablement insurance inside super and using it for a purpose other than paying out a death or disablement benefit, i.e. by paying out an LRBA or something. Well, ultimately, I think 407D puts that to bed a little bit, and we need to be mindful of it. So the obvious ones that all transactions must be via the bank account, lease in the name of the, well, this is an interesting one, whether the lease is in the name of the SMSF or the holding trust, because I think the right answer is the holding trust, because that's the name that the property is registered into. But if the lease is written up in the name of the super fund, obviously the auditors are going to be largely happy. But I think both solve the audit issues there. And then you've got your obvious liquidity considerations. How are you paying for the limited recourse borrowing arrangement? So I want to finish off just by running through an example of the total super balance and transfer balance cap. But basically, in real quick terms, the way that the transfer balance cap works, and this is probably the most in my opinion, an unnecessary piece of legislation, because most people that are entering limited recourse borrowing arrangements aren't doing it at the point in time that they're moving from accumulation to retirement, and they're certainly not then segregating that asset into their retirement phase and paying the loan out from their accumulation interest. But the way that it ultimately works is that if you do that and you move from accumulation, put the asset into pension and start an account-based pension with, say, the $500,000, then as you make your monthly repayments, you actually get a credit to your transfer balance account for the amount that ultimately should have been coming out of the pension interest rather than the accumulation interest. And so it can have an on-flowing effect to the transfer balance account. But I don't really want to spend too much time on that, because it's not really that relevant for the majority of people. I'd like to sort of finish and focus on the total super balance one, because this is only relevant to limited recourse borrowing arrangements that commence post 1 July 2018. So it doesn't apply to refinancing of 2018, pre-2018 LRBAs. And it's only relevant if the LRBA is between a fund and an associate of the fund, and the associate being a tax definition, but the tax definition largely replicating the SIS definition of a related party. So ultimately, if you've got a related party loan, then these rules apply. And it also only applies if the member has, or it applies if the member has met a condition of release. So ultimately, the way it would work, if we look at John and Joan, and they've got in their superannuation fund, they've got 1.2 and 800,000 each, so that's their total superannuation balance. They then have a limited recourse borrowing arrangement where they've got a $2 million loan. So that $2 million loan will ultimately increase their total superannuation balances proportionately. So because it's a related party loan, their balance is going to be increased proportionately, and we'll see that John will now have a total superannuation balance of 1.6 million, and Joan would have a total super balance of 2.4 million, which obviously then restricts their capacity to make contributions to pay down the loan. So strategically, with those related party loans, it can actually be an impact if they're looking to enter into them now. Now, there has been discussion around the fact that the total super balance rules don't apply to the intermediary limited recourse borrowing arrangements, because the loan isn't sitting inside the superannuation fund. All I would really say there is tread fairly carefully in that space. And of course, what happens if someone has met a condition of release and other members haven't, then that proportion of the limited recourse balance, limited recourse borrowing arrangement that applies to them is what increases their total super balance by. So I did highlight in the I guess the spiel about this presentation that I wanted to touch on some of the potential penalties for limited recourse borrowing arrangements. Well, ultimately, if you're in breach of your limited recourse borrowing arrangement, then you're in breach of the borrowing provisions, and the SMSF admin penalties can be applied, and that's 60 penalty units, which is at the moment $13,320 on the individual trustees of the fund. However, Section 67 is also a civil penalty provision of up to 2,400 penalty units. So, you know, without putting a scare tactic in there, if you're doing things really badly in the borrowing space and there's repeat offenders or whatever, the ATO may choose to go down the court process rather than the rectification or education or admin penalty. And then our penalties all of a sudden are fairly significant. So, you know, worst case scenario is $500,000 of penalties imposed on the fund, and you know the potential to if you have deceptively or you've done it deliberately, you can also be looking at that 5 years jail. So look, as I said, it was a real quick fire presentation to address all the key issues. I'm going to be addressing a lot of these a lot further later in the year on the road, and we'll also look at whether we do that digitally as well, virtually, I guess is the terminology. But to finish off, obviously, from a borrowing point of view, alternative arrangements should always be considered. So if you can make benefit payments in specie, maybe that's an option. Obviously, you can't do that with pensions, but it's something that you can look at doing rather than from a pure borrowing money in and potentially creating other issues for the fund, because the auditor's always got that right to ask the question. From an asset acquisition point of view, then do you look at other structures? Do you look at other ways to address things, either via tenants in common, where the other party might borrow against other assets? Do you use a non-geared unit trust? Certainly is still possible. And then the other one, if you do want to borrow, is to engage in an uncontrolled trust arrangement. Again, you need to be careful there, because once you get outside the domains of control, then you're not really in charge of the investment. And if you're in charge of the investment, then you've got control, and it's a related party trust, and you're back in the in-house asset doghouse. So you need to be mindful of that. So thanks very much for attending. The slides will be sent out to you with the CPD later this week, and the recording, the online recording, will be available on demand. So we'll send you the passcode, which doesn't change. We'll send you the passcode and the link for that with the slides and your CPD as well. So thank you very much for attending. I look forward to presenting to you again. I've got some dates coming up in May and then June, just tidying up some of those before I go public with them. So we'll let you know all very shortly when those are. So thanks very much for coming along, and I'll speak to you all again soon.